and the stock is trading at 115. How in the money is that put?
Well, it's 4 points in the money, Kurt.
4 points in the money, so $1 is the time value, right?
Mm-hmm. That's right.
Okay. Now at this time, the call options were trading for $2.05, but the put option plus the stock only risks $1. Okay, so there's a bit of a disparity there in the put and call pricing. Right?
Mm-hmm.
Now, here's what happened. The stock went from $115 to $120. Now that's not a very big move, is it?
No, not at all. So it's less than a 5% move. That's pretty reasonable.
Right. Now, when the stock is at 120, how much of the $119 put option is time value?
Well, now that the stock's moved up to 120, it's out of the money, so all of it is time premium.
All of it is time premium. Okay.
Mm-hmm.
Now, Mike, here's a very interesting phenomenon. That put option had been priced at $5. Now it's $2.05. So, did I lose on the put?
Yes, you lost on the put. We can't deny that. You originally paid $5 for it. It's now at $2.05, so you have a loss of $2.95, don't you?
Right. But in order to realize that loss of $2.95, the stock had to go up by $5. So I'm doing okay. And here's the other part of it. Mike, the time value portion of that put options pricing had been $1. Now it's $2.05. So the time value has more than doubled. That's an interesting phenomenon that happens, and we document that in the blueprint. It happens with every stock, with every option, both call and put option. As it approaches being at the money, the time value swells. Now, here's what we did. We took advantage of that bell curve, the ATM bell curve is what I call it, to swap puts. Did income method number 4 and added a year to the play and also bulletproofed the stock. And here's how it goes, okay? Mike, I bought to open a January 08 $128 put for $970 and sold to close the January 07 $119 put for $205. So now my total invested amount is $765. Now wait a minute. It looks like I put more money into the trade, doesn't it?
That's right. You did. You put $765 in there and added to our cost basis, didn't we?
That's right. Now this is the only one that does this. Income method number 4 is the only one of the adjustments, of the 10 adjustments, that actually is done at a debit. But let's look at the effect of it, okay? By the way, this is one commission, okay? When you close one put and open another, and you do it in, for example, Options Express account, this cost me $9.95 in commissions, $10.95, okay? Now, here's our original setup. DIA shares at 115, $5 for the put. I've paid 120 in, right?
Yes.
I do this spread trade with a single commission, and it gives me a cost basis of $765 more. All right. So far I've invested $127.65, right? All right, and this is my put option. It's a $128 put now. So how much do I have at risk?
Well, you've got a cost basis now of $127.65, but you've got a $128 guaranteed exit, so you're guaranteed 35 cents of profit. You have a negative maximum risk or guaranteed profit of 35 cents, and you still have an unlimited upside profit potential.
Right. I'm unlimited. I can't possibly lose, and yet at the same time we've got no way. There's no way to lose, but at the same time we've got unlimited prospects, okay? Now, Mike, in the red dot here, this is everything I've described so far, buying the stock, buying the put, rolling the put, okay, and making it bulletproof. Now, the rest of the chart represents the term of that $128 put, okay? It goes clear out to January 2008, and I did this in 2006. So, Mike, I've got 15 months. Did I forget to mention that DIA pays a dividend?
How about that? And at this point, it was a monthly dividend, wasn't it?
Right. Okay, so I'm still taking in income. At the same time, the stock is rising. And Mike, can you also see in here some really good opportunities to play income method number 6?
The money nets, maybe even income method number 5.
5 as well. That's right. Okay, we could use the money nets and pull in piles of premium without any kind of risk. Mike, would you believe me? A couple of years ago, if I told you you could do a bear call spread with 0 risk?
Well, it's kind of a hard thing to do, I would imagine.
Right. But we're going to show that next. Okay. So just before I do that, Mike. Oh, and by the way, here's my catchy sayings. I like to say, don't pick stocks, pick stops. That's how we begin a radioactive trade. Okay? And then I also like to say, don't time trades, trade time. Mike, you've seen where I've gotten in it with the lousiest timing ever. You've gotten into stocks with lousy timing, haven't you?
Yes, I have.
But because you did it correctly, because you played it with the put option and you knew the income method adjustments, you're able to take a losing stock and turn it into a winner.
Yes, I have.
Okay, Mike, let's ask what dollar amount we would have done better. Remember that poll that we did earlier? Asking what kind of difference it would make if you kept your losses last year down to 6%. And I'm pulling up this, and Mike, I'm going to want you in a moment, I'm going to want you to share the tools of power options, and we'll give a couple of recent trades so that we know these aren't just hypotheticals, and it's not just what I can do, it's not just what you can do, it's what our students have done as well. Okay, I'll give this pull about another 5 seconds. 3, 2, 1. If you haven't got your vote in, please do it now. And bingo. Okay. Now, Mike, 5% didn't get it. Okay, they didn't see that forcing yourself to not lose too much would be a good thing. Okay, but everybody else did. 5% would have saved at least $300 on your worst trade last year. 24% would be ahead by $1,000 to almost $5,000. The lion's share, if you had kept your losses down to 6% and also kept your wins, the lion's share would have saved or made $5,000 or more. Wow. And 10% recognize the fact that, hey, you know, when you're wrong, you could have minimal losses, right, and yet buy at the bottom. Because you haven't lost too much. You know, Mike, if you're playing with 100 marbles and you lose 6 of them, and then you've got 94, you've got a lot of chances to make that up, don't you?
That's right.
Okay. Let me go ahead and hide those results. And Mike, we're going to go ahead and talk about, this is one of my coaching clients from a few months ago, and then we're going to show some trades from another client here that he just did his last trade yesterday. Okay. Now, this was a personal coaching client that wrote to me. He was holding shares of McDonald's with a low cost basis. Okay, and he'd like to do these 3 things. You ready for this, Mike? McDonald's pays a dividend, but he'd like to have more than just the dividend income. He'd like to turbocharge it. He'd also like to leave the upside completely open, okay? And he'd like to make the position bulletproof. So, can it be done? The most popular way to take income is to sell a covered call, right?
That's right.
Mike, is that going to meet the other 2 criteria?
Well, no. It's going to generate some income, isn't it, Kurt? But we're not going to be able to limit our risk, are we? And we're not going to have unlimited upside profit potential.
Right. It does take income, but it doesn't limit risk, and it doesn't give you unlimited upside. Okay? All right. Now, a put option would give you unlimited upside, but Mike, does it give us any income?
No. We paid a little bit more, or we paid a little bit extra into this position. But, you know, we still probably have good return, an unlimited upside profit return, I should say, I'm sorry, but we did add some premium into the position.
Okay. Now, Mike, I'm going to mention that there's at least one covered call trading guru. This is how he's made his living, is by selling covered call seminars. And as recently as about 3 years ago, he was railing against the use of puts. He said, oh man, you should never use a put. And then he changed his tune. And